Good morning, everyone. We're a couple minutes before 10 o'clock, so we're going to give everyone a few more minutes to jump on here, and we'll be starting right away. Okay, good morning, everyone. We're right at 10 o'clock, so we're going to get going. We have a ton of information to cover today. So today we're going to be talking about the CARES Act, along with some updates from Governor Baker from this past week, and diving into some of the FFCRA updated questions as well, now that we have people starting to go out on leave. So I'm going to start with our standard little disclosure here. The information on this webinar isn't meant to be legal or tax advice. We want to make sure that you are consulting with your own legal and tax team. I'm going to add a little bit to this one today, as we are going to be talking about, obviously a big part of this is the payroll protection program that's coming out, applying for these loans. So this is specifically more to the Rogers Gray team. So myself, the other producers, our service team. So we aren't equipped to answer any questions on that loan in general. So we are going to try to make sure you defer to your tax or banking partner for those types of questions. We are already getting requests for help with pulling together some of the health insurance information as it pertains to those loans. So we'd be more than happy to do that. But as far as questions on the actual loans, we would just like to put out a little disclaimer there to make sure that you are consulting with your banking and CPA partners. So the agenda for today, we're going to go through, obviously, the CARES Act, Coronavirus Aid, Relief, and Economic Security, some of the business and tax loan provisions. We have a pretty dynamic tool, this Recession Readiness tool, that we're going to go through, and then some updates again on the FFCRA with the paid leave and some sample case studies. So I'm going to take a minute to introduce some of the presenters on today's call. So today we're actually partnering with Citrin Cooperman, who is the corporate CPA for Rogers Gray. So we're going to have on Mark Henry, who's a partner there, Poppy Barrett, who's one of the tax partners, and Laura Jenkins, who's one of the tax directors, in order to bring some light to the business aspects of the CARES Act. So we understand that there are some aspects on the individual side with some of these stimulus checks, but we're going to try to narrow it down today just to the business aspects, because that really is the most important part for those on the call today. And obviously we're going to have Jen Pinkham on as well, one of the founding partners from Pfeiffer Pinkham, to go over some updates on the FFCRA, and we're going to bring some business case studies to light, just so depending on where your organization is, we're going to try to give you some light on, based on what's happening with the CARES Act, based on what's happening with Governor Baker, give some insight on some directions that you can go. So again, here's the Citrin Cooperman team. So I believe Poppy's going to start, and Poppy, take it away.
Thanks, Jeff, and thank you, Rogers Gray, for hosting and collaborating with us on what we hope to be a timely and informative session today. We'll dive right into a quick overview of the CARES Act. As everyone knows, President Trump signed the Corona Aid, Relief, and Economic Securities Act into law last Friday, aka the CARES Act. Among the several pages of the act, we have individual tax provisions, as Jeff mentioned. We're not covering those specifically on this webinar. Those include the stimulus checks, some loosening up of some rules on the 401k distributions for 2020, and also eliminating some charitable deduction limitations for 2020 as well. On the corporate side, we will dive into what we think is the three hot buttons, especially with our client base. They are both tax and non-tax provisions. So we'll go through the various credits available to businesses as well as the loan programs. Mark will dive into comparing the different loans available and then also kind of tying that into our cash flow tool that we have built on our website. It's a recession kind of toolkit that he'll go through and tie it into all the deferrals and tax credit incentives that, will help businesses kind of project their short-term cash flows during these difficult weeks ahead. We're not covering any healthcare provisions. There were some extensive, healthcare provider provisions in the act. Again, we're focusing on the business-related items. So we'll dive in to those provisions. So as mentioned, we're going to dive into a couple of the business-related provisions. The first one is the deferral of payment on the employer taxes. Laura will give you an overview and deep dive into that provision and who qualifies. The employee retention credit is a credit meant to, retain employees on the payroll as opposed to, sending them to unemployment during these difficult weeks ahead. And then the next kind of group of provisions really relate to some modifications to the last sweeping act that we had at the end of 2017. And basically, with all the lower, tax rates that came out of that act, there were some limitations put in place, specifically with losses. There were some eliminations of loss deductions and limitations for both individuals and corporations. Those have temporarily been lifted, retroactive to 2019 and for 2020 as well. In addition, that 2017 Act eliminated the ability to carry back NOLs, net operating losses, for both individuals and corporations. That temporarily has been lifted as well, retroactively. So if an individual or a corporation did have a net loss in 2018, 2019, and of course 2020, there's now a 5-year carryback provision, which should be very beneficial. As we know, prior to 2018, the tax rates were much higher. So a loss today obviously is more valuable carrying it back in a higher tax year as opposed to carrying it forward. Corporate rate today is 21%. Prior to 18, the highest rate was 35%, as well as the individuals, business owners that are qualified businesses today. The maximum rate is roughly 30%. As we know, prior to 2018, the highest rate was 39.6. So again, if there's losses, more likely in 2020, just from our experience, our client base had really good years in 2018, 2019. So there's some planning to do in 2020 to maximize the loss and the potential carryback and the benefit there, looking at different accounting methods, bonus depreciation deductions. There might be some opportunity to maximize that this year for carryback and immediate refunds. Again, should stimulate and help cash flow. The other item that was put into place in 2017 was this interest expense limitation. Businesses and individuals were subject to a 30% limitation based on their adjusted taxable income for interest expense deductibility. So that's been lifted temporarily as well, retroactive to 2019. So instead of a 30% limitation, businesses and individuals can go back and use a 50% limitation in order to release some more interest expense and allow for some refunds there as well. The last modification of interest is the technical correction related to the qualified improvement property. When the 2017 Act was passed, there was an oversight with this category of fixed assets. It used to have a 15-year life, and this property was qualified for bonus depreciation. But due to error in the bill, this type of property received a 39-year life and was no longer eligible for bonus depreciation. So we've been waiting for this technical correction for a while, and here it is in this CARES Act, and it's going to allow a lot of retail and restaurants basically to go back to 2018 and 2019 and to correct that life and take bonus depreciation, which is 100% deductible in the year the asset was placed in service. So that should provide some relief for those industries and others. Other notable provisions: the corporate charitable expense limitation increases from 10 to 25% for 2020, and there's some tax-free benefits to employees if the employer makes payments on their student loans. So these were the three areas we felt obviously had the most interest, and we're going to take some deeper dives. We just want to note before we go into them that these cannot all be combined. These are not kind of double benefit, if you will, provisions. So the deferral of employer Social Security tax liability, that's the FICA piece of the employer piece of the tax, can be done by basically anyone, as Laura will mention that. Employee retention credit, again, is available to all employers, and the payroll protection program has some eligibility requirements. So if you note in the requirements and the kind of limitations how you can combine these provisions, employers can take advantage of the first deferral, they can take advantage of the second one, they can do 1 and 2, but the payroll protection program stands on its own. And if you participate in that protection program and that loan forgiveness, you can not take advantage of 1 or 2. So I know questions have come up, the interplay with wages and credits. Jen, I think you had a question or something came up related to the interplay with these three provisions.
Oh, Poppy, I'll jump on here quickly because I know I had a bunch of questions come through. As far as I know, there was some decision-making factors with the tax credit versus the payroll protection loan. So again, just to clarify, it's one or the other of those two, correct?
Correct. Number 3 stands on its own.
And Poppy, the question that my clients were asking related to the FFCRA and whether or not they could take the tax credits for the sick leave and the expanded family medical leave and also benefit from the programs under the CARES Act. So can you explain the interplay between the tax credits under the FFCRA and the CARES Act?
Sure. So there's basically no double benefit allowed. It's pretty clear the sick pay leave is going to be 100% reimbursed. So that kind of stands on its own, and those wages should not be included in any loan forgiveness calculation under the payroll protection program, and those wages should not be included in any employee retention credit calculations, as you're already going to get reimbursed for that sick pay.
Great, thank you.
So with that, I will hand it off to Laura to take a deeper dive into these first two provisions.
Thanks, Poppy. So we're going to first dive into the deferral of the employer Social Security tax liability that was made available in the CARES Act. So this provision allows taxpayers to defer paying their employer portion, so it's the employer portion only, of FICA taxes or railroad retirement taxes that would be attributable to the FICA rate. It's also available for half of the self-employment tax liability that is incurred by self-employed individuals, sole proprietors. So you can defer paying the payroll taxes that are incurred between the date of enactment, which was March 27th last week, and through the end of 2020. Any amount that is deferred would be due in 2 equal installments. So you would pay the first 50% of the deferral amount by the end of 2021, and the remaining 50% would be due at the end of 2022. It's available to all employers. There are no specific limitations put in place for this, with the exception of employers that receive the PPP loan that we're going to be talking about later, as Poppy mentioned. So we have a really quick example here. So if an employer had 75 employees earning $125,000, they would incur Social Security taxes of approximately $580,000 for the year. If we prorate that to the date of enactment through the end of the year, it would be about $436,000. So that amount could be deferred, and the first $218,000 would be due December 31st, 2021, and the remaining half would be due December 31st, 2022. It's optional, so you don't have to do this. And you should, check in with your payroll company for implementation of this, since they are generally the ones handling filing your payroll tax returns for you.
Great. And Lars,
were there any questions? Go ahead, Jeff.
Yeah, I was going to say, I have a quick question around that. So clients that are looking to do this, is there an application process, or what's the process they have to do in order to go through this type of deferral?
Yep, so no application is necessary. As I mentioned, you're going to want to check in with your payroll provider, but any interest and penalties are going to be waived on payments that are not made by the end of the year, and you have until those two dates that we mentioned, 2021 and 2022, to make the payment.
Okay, and then so to clarify that was a second question that had come through. So interest on those deferrals, it sounds like nothing through the end of this year. Is that correct?
That's correct. All interest and penalties will be waived. So essentially, you're receiving an interest-free loan from the government if you take advantage of this.
Okay, thank you.
Yeah, of course. Okay, so now we will talk about the employee retention credit. So there are limitations on this credit, which we will go through, versus the payroll tax deferral that anyone could take advantage of. So this provision is going to provide a refundable payroll tax credit equal to 50% of certain wages that are paid by eligible employers. It's available to all employers, including nonprofits, if their operations were fully or partially suspended as a result of a government order limiting, commerce, travel, or group meetings. It's also available to employers that experienced a greater than 50% reduction in their quarterly receipts measured year over year. So comparing, the second quarter of 2020 to the second quarter of 2019. If you had a 50% reduction, greater than 50% reduction, in receipts for that quarter. So any eligible wages that are incurred during that time period are eligible for this 50% credit. Eligible wages depends on the number of employees that you have. So for employers with 100 or fewer full-time employees, all of the wages paid during that time are eligible, regardless of whether or not an employee is furloughed or still working. The credit that's provided is going to cap off at $5,000 because it's limited to the first $10,000 in wages for each eligible employee. For employers that have over 100 employees, then the credit is limited to wages that are paid for employees that are currently not able to work as a result of the shutdown that you're facing, the government order. As Poppy mentioned previously, wages don't include any wages that are paid as a result of the sick leave or family leave under the FFCRA, because you're already getting a credit for those. The way that you can receive, so it's a refundable tax credit. You would claim the credit on your payroll tax return when it's filed. However, there is going to be a Form 7200 available. It's out in draft right now, that you can request to have the credit refunded to you in advance of having to file. And again, employers that receive a PPP loan are not eligible to use this. So you can use the employee retention credit in conjunction with the payroll tax deferral, but you cannot use it if you are receiving a PPP loan.
And thank you, Lars. I want to pause here for a second because I know we've had a bunch of questions here. And Jen, I actually have a question for you here. So this might be a little bit selfishly from my standpoint, but we know that health insurance has been connected to both the FFCRA and CARES Act in a couple different ways. And so the CARES Act, it seems like here and in the PPP. So do we know that for health and costs paid for employees that are on furlough, which we've seen with clients, there are a lot of those employees that are. Do we have a clear direction on how those costs are going to intertwine with this retention credit?
We really don't at this point. We are receiving some conflicting information. On the one hand, as you all know, if you've furloughed an employee but you've kept them on your health plan, they can't be on your health plan without being considered an employee, because your health plan wouldn't allow that. And the health plans have limited their restrictions and reduced their restrictions so that employees working 0 hours are still eligible for health benefits because of the pandemic. So on the one hand, they are your employees. On the other hand, the IRS has given some guidance as to what are qualified wages. And they've said qualified wages include health plan expenses, but they've also said those healthcare expenses must be allocable to the wages. And in this case, the employee wouldn't be earning any wages. So we're really not sure, as far as this employee retention credit is concerned, whether or not you're going to be able to receive benefit for the healthcare expenses that you're going to be paying for those furloughed workers, because we're not sure whether they're going to be qualified wages or not. We're hoping the IRS gives us some further guidance on this, because we know that there's a lot of employers out there that have furloughed workers but kept them on the health plan. So we're hoping that the IRS allows those health plan expenses to be allocable, but we're not positive on that answer yet.
Okay. All right. Thank you. And then so back to Laura. So for this retention credit, does this still apply if employers are paying their full wages, but then employees happen to be working reduced hours? So maybe they're not on furlough, but their hours has been reduced. So can you still use this retention credit in that scenario?
Yeah, that's a great question. So the credit will apply. And again, it comes down to the number of employees that the employer has. So if you have under 100 employees, then the credit will apply for any wages that are paid during the period, and that period is through the end of the year. However, if you have greater than 100 employees, then the credit only applies for the portion of the wages that are being paid to the employees when they're not working, again, as a result of a government order, suspension of your business.
Okay. All right, thank you. And so we've tried not to get too industry specific on any of these, but I do have a question that's just come up just more often than not, since we kind of dabble in this industry a lot on our commercial side. But so contractors have been pretty explicitly mentioned throughout the whole CARES Act. So a quick question that's come up, so their job site, if a job site has been shut down based on a governor order, like we're going to talk about with Jen later, does that count as a quote unquote partial suspension of business?
Yes, that would count. So there's actually some really good FAQ on the IRS website in relation to this credit as well. If you go through that, the definition of partial suspension is if a business can continue to operate but not at its normal capacity due to a government restriction. So any job sites that are being shut down is going to reduce the normal operating capacity for a contractor. That is considered a partial suspension of business. And so for those wages being paid, again, if you have over 100 employees, to any workers that aren't able to work because those job sites are shut down, then that would be eligible for this credit.
Okay. All right. Thank you. And then I think the last one for this section here. So we've had a lot of organizations that we've talked with have furloughed employees. So we're seeing that as a pretty common practice. So can an employer bring those employees back and then take advantage of this retention credit?
Yes. So any qualifying wages that are paid between March 12th and December 31st of 2020 will qualify. So as long as they are an employee, at some time during that window and you're experiencing an interruption in your business, any wages that are paid during that time will qualify. So you can certainly bring people back, and if you start paying them so that you're kind of ready to hit the ground running when things reopen, then those wages will qualify even though you previously furloughed them.
Okay, perfect. Thank you very much. Okay, excellent. I think that's all the questions we have for this part now. So thank you.
Okay. So I think with that, I'm going to pass it over to Mark, who's going to go through a high-level comparison of the various loan programs that are available.
Thank you, Laura. Yeah, so as you can see, this is a grid really just focusing on the two major disaster loans that are available, PPP and the EIDL, the Economic Injury Disaster Loan. But before we get into it, I'm sure there's a lot of people on the phone that have either already pursued the SBA, have lots of questions about the PPP loan today, and people are in various stages. The one thing I would recommend to everyone out there is I think what we've all seen in our own client base is almost three buckets of situations that have happened. We have clients, 3 weeks ago when this all rolled out, were doing phenomenally well. For whatever reason, they were in a niche business. That business was booming. They were doing really, really well. No concerns about anything. They were hitting the ground running. Loans was not something that they had a concern with. No furloughs, nothing like that. We had clients in the middle who didn't really know where this was going to go. Right? They obviously knew it was an issue. They're trying to figure it out. They kind of went across a week or two until some sort of impact started hitting them, whether it was supply chain, whether it was people not paying them, any sort of issues that were kind of happening up during that period. And then we had the third tranche that they were hit immediately, right? The restaurant industry, the hospitality industry, they had to make quick furlough decisions, and they were looking at loans right away. So I'd say for the past 3 weeks, that's the majority of where my time's been and our firm has been, really spending a lot of time with people, walking them through the loan application process, what they need to do, as kind of we're all figuring this out together. The SBA loan has been in existence for a while, but obviously there's a lot of new questions with the PPP loan. And the one consideration I would share again about those clients that were booming at the beginning of this period is that things are changing so rapidly, and some of those clients that were doing extremely well 3 weeks ago are now calling and say, hey, things slowed down, and that little niche boom that we had is now slowed down. What do I do about loans? So I think everyone's going to be impacted by this at some point. You could be booming and doing work for customers that can't pay you because they run into an issue, or God forbid, one of my clients had a COVID issue and now they have to shut down, right? So that's something completely out of your control. What are you going to do? Make sure you're taking the steps and get the applications ready to kind of have these loans in place in case something were to happen. So walking through this program, I'm going to go to the right side first, the EIDL loan. This one is basically for three weeks. People have been applying to this loan. You can get up to $2 million. The criteria is all determined by the SBA, so businesses that meet the SBA size standards. And if we have the link later in the presentation, but if people want to Google while I'm talking, just Google SBA size standards tool. It'll take you to a link. It's very quick. It'll ask you if you're federal contract purposes, hit start, enter your industry or your NICE code if you know it. It'll take you to the next phase. And what you'll see there is two different requirements typically. Is every industry is different. So I can't say, hey, it's just 500 employees or it's just 20 million. Every industry is a little bit different. For hotels, it's 35 million is the criteria. For manufacturing companies, it's a different criteria. So enter that in and that'll give you kind of a pre-qualify whether or not you meet here. And that tool will be later on in the presentation as well if you didn't get that. Then walking about the use of proceeds, so payroll, equipment and machinery purchases, real estate payments, other bills you cannot pay due to COVID-19. And then the next one is collateral and personal guarantee. And this is where when people are contrasting the two loans, they clearly like the PPP loan better because that obligation is waived. The one trip you want to consider here on the personal guarantee is just make sure if you do apply for the SBA loan, talk to your bank. Right? We don't know where that loan will sit in the pecking order. Is it going to be subordinated? Where does that fit in terms of your grid? But also going to your bank and saying, hey, can I have access to capital? Can I draw down on my line? Will you give me seasonal increases on the borrowing base? Give me some other flexibility options before I have to go and put a personal guarantee, because that can be, for some of my clients, that's a no-brainer. They are not doing personal guarantees regardless of what's happening. So The next rule, affiliation. This gets pretty complicated, and I'm not going to go too in-depth on it because everyone's situation is different. Just be aware that if you are part of a company, say you're a PE-backed company, or you have separately managed businesses with common ownership, those are going to kind of get pooled together. Make sure you're talking to the SBA or your banker about the requirements that you meet, because it's very specific. Credit elsewhere, both of those are waived. Forgivable on the SBA side, no. So that's just something we'll get into the PPP side, and Laura's going to go much more in depth than I'm doing. I'm just doing kind of a high level comparison. The interest rate on the SBA loan is 3.75% for businesses and 2.75% for nonprofits. And the phenomenal piece is up to 30 years, right? So if you're eligible, very cheap financing, 30-year loan. So it could be a great tool to kind of get you through everything. Now on the PPP side, this max loan amount, this is very high level. Laura will walk through the details. There's a lot of details here, but essentially it's 2.5 times payroll costs with a maximum of up to $10 million per borrower. And a slide after this, Laura will kind of walk through those details. Now eligible borrowers is a little bit all over the place. So if you meet the first two bars, for most people, you'll either be SBA size standards or just less than 500 employees. So that's kind of like the easy line to pass. When you get into the third bullet, that's really targeted at hospitalities, franchise locations. You have multiple locations with 500 employees or less. You're allowed to apply for each of those locations. So that's something, if you're in those industries, definitely ask your CPA firm, ask your banker, and get some clarity. Also nonprofits with fewer than 500 and some other industries as well. The use of those proceeds is a little bit more restrictive than the EIDL. It's payroll, utilities, real estate payments as well, but it's not mortgage payments. It's interest on debt payments. So be aware of those details as well. The big thing is the personal guarantee is waived. Similar affiliation rules, so definitely research those. Credit elsewhere is waived, and then the forgiveness. So this loan can be forgiven, and Laura will walk through that calculation. That is something that's somewhat of a moving target. Banks, my personal belief is banks are going to end up creating calculators once they have better clarity here. And you're going to be kind of working with the bank to walk through all that information to determine what that pool of costs will be. The interest rate actually just changed. This is the third rate change in 4 days. So it started at 4% on Monday. It was 0.5% for a couple days later on a 2-year term. It was actually 4% for 10 years, then 0.5% for 2 years, and now it just got bumped yesterday afternoon to 1% for 2 years. There are deferrals of payments. It's over a different amortization period. So one thing to be aware of is there's probably going to be a balloon payment after year 2. So you just want to make sure you understand what your options are when that balloon does hit. What are you going to do? So with that, I think that's the loan comparison, and Laura's going to walk into a lot more detail.
And Mark, I actually want to jump in. I have just a quick question, because as we've been, again, I'm obviously not a CPA, nor am I a banker, but looking at this just in a vacuum, is there any reason why someone wouldn't apply for both of these right now? I just had an email from a Chamber of Commerce advising everyone to apply for the, that $10,000, the SBA, where you can get it up front. So is there anyone, if I own a business with however many, 50, 100, 200 employees, is there any reason why I wouldn't be applying for one or both of these right now?
Yeah, that's a great question. I've gotten that question a million times as this all has rolled out. So the U.S. Chamber on their website actually specifically says you can apply for both loans. So yeah, you can. The only nuance, and you're going to have to figure out a way to track these separately, is both loans have to pay for separate costs. So I think we can talk a little bit later about how to maybe track those costs separately. But yes, our recommendation, go apply for both. The bank's going to determine if you're eligible or not, and you're going to walk through that process, but there's really no reason you shouldn't. The one thing, the interim guidance that was issued by the SBA last night did say is you can apply twice for the PPP. So that is one thing, just came out last night. So all hot off the press, but my interpretation is say you put an application in for today, circumstances change 3 weeks later, they're not going to allow you to apply twice on the PPP side. But yes, on SBA versus PPP.
Okay, yeah, and I had one person say, I was talking with a local banker, mention that, they had one organization that had a bunch of different subsidiaries where I think they got 7 or 8 applications just from one person. So it sounds like that can potentially happen as well, correct? It's not just necessarily, from one organization that has multiple subsidiaries under it. You could theoretically have a loan for each of those, correct?
Yeah, and that's what we're hearing from banks. And some of the recommendations we're hearing is really, however you apply, make sure it ties into your 940s and 941s. And the banks will obviously release guidance on exactly what they're looking for. But as of today, we're hearing that however you're applying, make sure it ties into those payroll reports.
Okay. All right. Excellent. Laura, do I have you on the right slide here?
You do. Thank you.
All right. Perfect.
So we're going to jump in a little bit deeper to the guidelines of the Payroll Protection Program. I'm going to start this section by saying we have been, living and breathing the PPP program every minute all week, and I feel like I still have more questions than I do answers. So I'm going to go through the details here as we know them and understand them, but obviously there are still a lot of areas that we're waiting for further guidance, and I'll point that out as I walk through it in more clarity. So we'll take a deep dive on what we know so far. So the Payroll Protection Program was part of the CARES Act. They've set aside $350 billion allocated to small businesses meant to help retain employees during this time. So everything about the qualifications for the PPP was meant for this employee retention usage. Loans are going to be advanced to cover payroll, and then there are certain other qualifying costs that we'll go through during an 8-week period that's going to happen sometime between February 15th, 2020 and June 30th of 2020. And that 8-week period begins when you receive your loan disbursement. So that could be a little different for everybody. There is eligibility for forgiveness if borrowers show that they've retained employees, which we'll go through. There are a couple calculations on that that we can walk through. Mark already kind of went over this, but eligibility for this loan is, employers having less than 500 employees, including nonprofit employees, nonprofit businesses, and also sole proprietorships. Or if you have more than 500, but you otherwise meet the SBA size standards, you would still qualify. Any companies in the hospitality industry, they did set aside an exception for them where they're able to look at employee counts on a per location basis to be able to qualify. So how much money can you borrow under the PPP loan? So there's a formula to determine what your maximum loan amount is going to be, and that is equal to 2.5 times the average total monthly payroll cost that the company incurred during 2019. I'll caveat this with some additional guidance came out from the SBA last night, and in that guidance, it actually stated that it's going to be the average total monthly payroll cost for the last trailing 12 months. But the application that was released this morning still says it's based on 2019. So there's a question there. As I said, we have more questions than answers, but when you're pulling your data to determine your average total monthly payroll costs, it's probably a good idea to pull all of 2019 through March of 2020, just so you have that data available, and work with your bank on what exactly they're looking for there is our best advice right now. Payroll costs, there's a specific definition of what is included. So any salaries, wages, commissions that are paid to your employees, including payment of cash tips or the equivalent for our restaurant and hospitality companies. That's going to include state and local payroll taxes that are paid on behalf of the employee. It also includes any vacation, parental, family, medical, or sick leave. We'll get into the exclusions, but sick leave paid under the FFCRA does not qualify, however. So your regular sick leave programs, PTO, would qualify, but not the FFCRA. Any severance payments are included, and any healthcare benefit costs and retirement benefits that you pay. So any 401k match or group healthcare would qualify. You do not include any compensation that's paid to an employee in excess of $100,000. Some clarity did come out on that. You still include the employee up to the first $100,000 that they receive, but you would have to exclude any amounts paid to them in excess of $100,000. Not on the slide, but the employees need to be, residing in the U.S., U.S. citizens. And you are going to exclude any federal payroll taxes. However, the guidance last night says only if they were paid or withheld between February 15th, 2020 and June 30th of 2020. So when you're looking at your average monthly payroll costs for 2019, that shouldn't really come into play because that time period is just limited to that window. So, your maximum loan, sorry, go ahead.
Yeah, Laura, we had a couple questions come in there just on the seasonality. If you're in a seasonal business, can you provide, I know with the FFCRA, they take it was an average of the last, however, I think it was 6 months or 12 months, but how if you're in a seasonal business, how would that be affected if you're trying to calculate your payroll costs?
So if you meet the definition of a seasonal business, there is a different time period that you're going to use to calculate the average monthly payroll. It won't be based off of 2019 as a whole. It's going to be based off a window of time in there. Okay. And, you need to work with your banker. So that is one of the things that has not been defined yet, is who meets this definition of being a seasonal business. So, really you need to work with your banker on that as to whether or not you truly meet that definition and can use that separate window for calculating your cost.
Okay, thank you.
Mm-hmm. So once you've figured out your average monthly payroll cost, you're going to take 2.5 times that amount. That's going to be the maximum loan amount you're able to borrow. That is capped at $10 million for, some of the companies that have larger payroll costs. You're going to be capped at this $10 million amount. Once you've received the money, the next big question is, what can I spend it on and how is that going to be forgiven? So if the amount, if the loan proceeds that you received are used during the first 8 weeks to cover payroll costs, which are going to have the same definition we just went through, any mortgage interest payments, rent payments, or utility payments, then those costs are eligible to be forgiven. There is a requirement that 75% of the amount you spend during that 8-week period needs to be on payroll, and the remaining 25% can be on these other mortgage, rent, and utility payments. So if you meet that criteria, let's say that you took out a loan of $500,000 and you spent all $500,000 appropriately on these costs, you're eligible to have up to the full $500,000 forgiven. However, as we mentioned, the purpose of this was really meant to encourage businesses to retain their employees. So there are a couple of formulas you have to go through where you may have to reduce the amount of forgiveness that you're eligible for, and that's based on employee retention. So the first formula, what you need to do is you would compare your average full-time employees on payroll during the 8-week period that you were making those payments, and you would compare that to what your average full-time employee base was from February 15th, 2019 to June 30th, 2019, or from January 1st of 2020 to February 15th of 2020, and it's going to be the lesser of those two numbers. So say you laid some employees off and you have 50 employees during the 8-week period, but before all of this happened, you had 100. You would be taking 50% of the eligible payroll costs that you paid with this loan, and you would only be eligible to have 50% forgiven. In the second formula, you've got if there was reduction in wages greater than 25% for any one employee that you were paying during the 8-week period as compared to their wages in a previous quarter. So if you had to reduce their hours and reduce their wages more than 25% compared to the previous quarter, then you're going to have a reduction of the loan forgiveness relative to that ratio as well. There is, of course, another caveat to this. So first we said, how much can I forgive? Now we're going to say, how much of that forgiveness do I not get because I didn't retain enough people, perhaps? However, written into this is if you bring the employees back onto the payroll or restore their wages, if they had reduced wages, by June 30th, then you're able to use them in the numerator of those formulas, even though you maybe weren't actually paying them during that 8-week period. So it's a possibility for you to bring employees back and then not have to have as much of the loan forgiven. So pretty complicated. I hope I covered that in a way that you could understand, but certainly no additional guidance has come out yet with regards to the loan forgiveness calculation. So what we have here is kind of all we've received for guidance so far. And in the guidance last night, they did specify that more detailed guidance is forthcoming on this.
Yeah, and Laura, so when I first read this, so I read that your payments can be deferred on the loan. So I guess first part of the question is that true? The payments can be deferred?
Yep. So payments can be deferred for the first 6 months after you've received the disbursement of the funds.
Okay. And then so follow up to that. So let's assume we're deferring payments, and let's assume this loan is only used for this 8-week period after the origination. And everyone meets all this criteria, so they're using 75% of it for payroll costs, 25% for everything else. And let's say they either haven't laid people off or they plan on bringing everyone back by June 30th. So technically, you could get a loan that you make 0 payments on, and if you meet all this criteria, theoretically never have to make a payment on. So it's almost, I hate to say there's no such thing as a free lunch, but it sounds like this is a scenario where you could potentially get 8 weeks assuming you meet all this criteria, which there is, you do have to go through those steps. But if you defer the payments and you do everything you're supposed to do, it sounds like you can just get 8 weeks of freebies.
So yes, in theory, that's true. I do think that, the hurdles you're going to have to jump over are going to be difficult. So I don't want everyone to walk away thinking it's a guarantee that you're going to get a free money for 8 weeks. But it is definitely possible in theory. The guidance last night also pointed out that, as you're deferring the payments for the first 6 months, interest will accrue, but that accrued interest is also available as part of the forgiveness. So, it's possible that if you met, as you said, if you met every single criteria and did everything perfectly, the full amount, including the interest that accrued during the 6 months, can be forgiven, and you end up making no payments.
Okay, excellent. And I think that's probably a pretty good, I know I chatted with Mark about this yesterday, but that's probably a pretty good segue to jump into this recession tool. I thought this was a fantastic tool that you had, Mark.
Yeah, thank you very much. And so everyone can kind of see, this is the front page of our recession endurance assessment. It's on our website. So if you go to sitchinkuperman.com and you'll see our recession readiness area, and we'll have a link in for the back if you want to get into it. But essentially, it's for our current clients, and it's also just for other business owners if you want to run it on your own. The way the process works, or it has worked so far, is it usually takes us a couple days to accumulate the information, put it in a format for you, and then we'll ship it off via email to you and have the opportunity, if you want, for us to walk you through it, or you can just take it and run. It's just kind of free guidance on what we're thinking and some things you should be considering as we kind of line up towards what seems to be a potential recession. So as you can see on the front page, David Ortiz filled this one out for his manufacturing company. What I'd like to do is first kind of flip over to access to capital. And what you'll see once you get to the questionnaire, you'll see that there's probably 70 generic questions. And I know that sounds like a lot, but in order to you'll see the benefits of this tool. In order to create all the information, there's a decent amount of questions you do need to answer. If you see the bottom half of this grid, most of them are yes, no, or drop down. So it won't take you, I've actually filled one out for a client on my own. It took me about 20 minutes, so it didn't really take that long. What I will focus on is really the recommendation part. And again, not everyone knows the background of what this company was, so let's kind of just walk through some of the outputs. So for this individual, for David Ortiz's company, he needs to improve his access through lines of credit. Now, this is one thing that we definitely want to make sure people are proactive for. Most of our clients have already done this, but If you haven't talked to your bank about any concerns that you have, make sure you're talking to them to get access to capital first before you even go to the loan step. So that's something you want to really, really consider. Second one down is evaluate qualifications for SBA loans and the PPP loans. So in here, based on the questions that they answered, that was a high risk. So that's something you clearly need to do if you don't have the option to capital right away. Improve collections activity. Start making daily calls, sending letters, re-invoicing. What we're seeing is a lot of slowdown in payments on AR. So get out in front of it, have daily conversations, make sure your teams are asking those questions. Make sure you have safeguards in place to monitor credit insurance, right? If you have credit insurance limits, make sure you're not selling over those limits. I just heard from a client yesterday that their credit insurance company is actually limiting the amount they'll give. So they used to be able to sell through a certain amount. They now cut them down to zero. So on all future invoices. So make sure you're out in front of those conversations so that you don't run into an issue on collections. Discuss covenant relief with your bank. So this kind of gets into 2020 projections, 13-week cash flow forecasts, really understanding what the economic impact of this will be on your business. And you want to be out in front of those conversations now. Say, to your bank, I don't think we're going to meet our projections. What can you do with me? Obviously I might be looking for a waiver already based on the repercussions for 2020. And then implement new cash forecasting capabilities. So one thing, and I'm not sure if everyone's familiar with it, is a thing we call a 13-week cash flow forecast. And it's really, some clients use daily forecasting, some use monthly and annually, but based on where we are in the world right now, weekly is definitely a strong recommendation. And it's just because things are adapting so fast that you really need to break it down to a minute level to really get your arms around what's happening, what you need to do. So this customer definitely needs to take a look at implementing a cash flow forecast, and that's something we can help people with if you don't have a CFO that is able to do that for you. So kind of walking over to decision support. So now that you're in this, what are you doing as a management team to kind of make good decisions? So implement monthly close, even weekly closes. You want real-time financial information the best you can have it. So work with your accounting team. If you don't, work with your CPA firm. Supplement whatever you can do to be on top of all your numbers to make sure you really know what decisions you need to make quickly. Replan the rest of your year. You'll see that a couple different times throughout this. Reforecast, right? Every single day, your decisions are going to change, right? A supplier goes out of business. You got to find a new supplier. Receivables for one account you're not going to collect those. You lose employees. Things are changing rapidly, so just reforecast. And that ties into kind of one of the other key recommendations, implementing a monthly reforecasting process. And I'm not going through all of these. I mean, you'll get a copy of this. You can take a look at all the questions and recommendations, or just do the tool yourself. But these are kind of the key things I think that each area focuses on. Kind of flipping over to expenses. In this case, red is bad, so this did not go well for this applicant. But review your vendor contracts, right? Are there potential price increases? What about lease agreements? Are you talking to your real estate vendors and making sure can you push out lease? Can you change terms? What can you do? Make sure you're monitoring all your vendor contracts and understanding what the clauses are and what outs you may or may not have. Implement emergency expense control measures. So I've had a lot of clients have to make really, really quick decisions, cut marketing budgets, non-discretionary spending, credit card limits, anything you need to do to cut non-critical support right now. You have to make those decisions quickly, but make sure before you do that, pull them all together, figure out what's essential for your business, and then make those decisions. And then evaluate capital projects. So are there certain capital expenditures that you have to make this year, or are there certain capital expenditures you can delay for another year? So what we've done is kind of create a capital expenditure plan with all of our clients. What's critical for 2020, 21, 22, and really make those decisions to kind of reduce cash flow expenditures as much as you can. There's some CapEx that you have to do to stay in business, or some that for environmental reasons you have to do, but just make sure you're monitoring that. Flipping to the next slide, positioning. So this is really key, right? So there's a lot of difficult decisions that are being made by a lot of businesses, right? Your leadership team, maybe you have to make some employee cuts. So what you really need to do is go through your org chart who's key, who's non-key, who would be kind of your pecking order. Maybe you rank everybody. Who would be critical to your business operations? Who could get let go first? Kind of restructure comp plans. Really kind of think about all of that through. But then also, you really want to incent those individuals that are part of your key leadership team to stay on board, be kind of positioned with you, and make sure you're kind of bringing them into special teams. There's so much information, so many decisions that need to be made that you really need to bring your leaders together. And then evaluate compensation. So that's one thing that is constantly changing. Do you furlough? Do you lay off? Do you cut people down to 4 days, 3 days? So lots of decisions being made there. And then lastly, going to supply chain. So this is a manufacturing company, so this is key for them. But really kind of evaluating other sources. So what I've seen happen is, whether you're buying product from China and that got cut down, you can't get access to product, or one of your suppliers comes down with COVID, they shut down facilities, auto dealerships, that happens. What are you going to do next, right? Are you going to go to a local source? Kind of create supplemental sources of supply chain. Make sure you're ahead of that. So start discussing those supply needs with suppliers. What can they do for you? Maybe even just reduce concentration risk. If you have concentration with one key supplier, make sure you're starting to supplement that now so that you're ready to go, you're front of the line when you need to increase that capacity. And then build a financial model. So we've seen a lot of clients be very successful kind of converting their business model to key things that they're kind of good at now that are going to be more profitable for them for the short term. So if there's products you're making right now, there's things you're doing right now that aren't profitable or nobody's buying, try to shift your business to something that's more profitable and go from there. So this is kind of, this is specific to this example company, but this is a great tool to really kind of do a quick assessment right now of where you are, things to focus on, but then even 3 months from now, a month from now, reassess and kind of change your game plan to see where you need to go for the future.
Yeah, that's fantastic, Mark. So that's where I find my biggest questions there are, if you're a business right now, you're trying to weigh loans, not loans. All of a sudden you have people requesting paid time off through the FFCRA. You're not sure if your bank can handle this. I think the overall question right now is just where do businesses even start? Is it a starting with your banking person, with your CPA, with, where would someone just even try to get going if they're trying to wrap their mind around this right now?
Yeah, I think that it's a great question. I think the best thing to do is, I think your CPA firms and your employment lawyers will kind of mirror up together in these decisions, because a lot of them are intertwined, right? Am I going to make furloughs? Am I going to make cuts? Do I qualify? Poppy had that slide before. What's my mix? 1, 2, or 3? Where do I fall? What should I do? And then that'll feed you to the banking decision, right? So should I do number 1 or should I do the loans? So I think you talk to your CPA firm, talk to your lawyers, get on the same page, and then go from there.
Right. And so I'm going to ask, we won't hold you to this, but I'm going to ask the $1 million question of, obviously there's $350 billion available. I think I saw a stat, 95% of businesses across the United States are under 500 employees, so they qualify for this. So despite the fact that that's a lot of money, the assumption that it's going to go pretty quickly. So, in prepping people to get these loan applications in, if that's what they're doing in an efficient manner, can you just maybe best practices with your clients on what you're doing to have them get everything ready, so maybe that it doesn't get rejected and kicked to the back of the line, or what are you hearing from banks in general about what's going on with that?
Yeah, it's evolving very, very, very quickly. We actually, an hour ago or an hour before this phone call, they just released the 3rd version of the draft SBA application on the SBA's website. So if anyone doesn't have a bank that they're working with already and doesn't have an application, you can go there and kind of see all the requirements. It's a very easy form to start. It'll probably take you 10 minutes altogether if you have some of the information you need. You do need to make some of the assumptions that Poppy and Laura alluded to earlier about number of employees, how you calculate the payroll numbers, but the rest of the form is pretty good. But really, the best thing that I've heard from bankers is have all your 940 and your 941 information together, right? Have all your payroll records together. They're not going to ask for it on the first round of that first app from what we've seen, but they're definitely going to be asking about it very, very shortly.
Right. So that's something that could potentially delay getting funds if you don't have that stuff ready to go.
Yeah, and just to add to that, I don't want to create any. I do want to, instill a little bit of a sense of urgency. The interim guidance that came out last night from the SBA did clarify that it is first come, first serve. That was issued in the interim ruling last night. So that is something our recommendation is, try to figure out your eligibility and get those applications in as soon as you can.
Right. Yeah. And I guess I actually never closed the loop on my $1 million question, but how long do we think that money is going to last? So, I mean, I've heard people say a month. I've heard people say a couple weeks. I've heard people say 1 week, which that might be. But I mean, like you said, first come, first serve. And we're hearing I talked with one banker yesterday that got like 200 applications alone. So my guess is it's going to move pretty quickly.
Yeah, and that's our assumption. And we had an internal call with about 20 of us earlier this morning to share experiences of what we're hearing with our clients and bankers. And some people alluded to everyone's alluding to the money is going to be gone very quickly. But some people are alluding to the government's going to do another round. There is a fourth version of the stimulus, in the works. So we don't know what that looks like yet, but there's talk about more money coming. But yeah, it is the $1 million question. We don't know the answer, but all we know is that this round probably will go quickly.
Okay. All right, cool. And this slide up here right now has obviously a bunch of links. We'll make sure, just like all the other webinars, this will go out. So we are right at the 11 o'clock mark. So I do want to flip over to Jen's part of the presentation. If there are any questions that have come in from anything that we've gone over now, so any questions, clarifications, if you want to get those in, we'll do our best to answer some on the back end. But if not, we'll kind of do the same format where we'll try to get FAQs and at least the information we send out along with this recording. We'll try to make sure that there are resources where you can get all of those answered. So that being said, thank you very much, Citron team. That was fantastic. I know we probably kind of benefited from waiting until the end of the week here. I know there's been a CARES Act webinar, probably 10 per day now this entire week. And I know we kind of got the benefit of getting all of this last minute information in there, but thank you very much for putting that together. So Miss Jen Pinkham, obviously she's been a fan favorite for these webinars. So I thank you again for jumping back on here. Obviously we have some updates in the land of COVID just coming out this week. Do you want to spend a couple minutes going over those, and then we'll jump into the FFCRA update as well?
Absolutely. So on March 31st, the governor extended his order relative to essential services. In addition to extending the order through May 4th, which coincides with the school closures, he provided some more clarification on which businesses are considered essential. And so I would encourage everyone to visit the mass.gov website, which provides that link and gives all of that information. The prior order was about 9 pages in length. This one is about 16 pages in length. So there's a lot more clarity on who is essential and who isn't. I wouldn't say they really deleted people. If anything, they added a lot more people to the list of those who are essential. And they did so based on the FAQs that they had gathered and had posted from the time period that the last order was in effect until this new order took effect. So a lot of businesses had written in and requested to be put on the essential list, and there were FAQs that were developed and answered questions as to who was essential and who wasn't. So this new order, everyone should go and check it out. If they're concerned whether they're essential or non-essential, they should visit that and see if any changes have been made that impact their business. Also, with regard to the Family First Coronavirus Response Act, the Department of Labor has issued many FAQs that give us a lot of clarity, which we're going to talk about some of the clarifications that they've provided. The last webinar we did, there were 14 FAQs. There are now 59 FAQs. So they've really tried to provide guidance and insight as to the FFCRA and how it impacts businesses and how it's really going to be implemented in practice. So hopefully we're going to answer some of those questions today and go over some of the FAQs that they've provided.
Yeah, Jen, do we want to dive right into the FFCRA right now, just so we can spend some, now that leave requests are coming in and it's actually starting to happen. Do we want to spend some time just reminding everyone about that and giving them some insight on some of the new things that we've gotten on those FAQs?
Absolutely, sure. So with regard to the FFCRA, all of you that are on this webinar likely know that the FFCRA provides for paid sick leave of up to 80 hours, and it also provides for expanded family and medical leave to care for a son or daughter whose child care has closed. So there are a variety of FAQs that the Department of Labor has now given us guidance on, and some of them relate to whether or not people are eligible if businesses have closed. So I just want to quickly let people know that if a business has closed because of the governor's order before April 1st, or if the business has closed because of the governor's order after April 1st, because of his new guidance, your employees will not be eligible for paid sick leave or expanded family and medical leave. So because the closure relates to the work site, the lack of business, or a closure due to federal, state, or local directive, in this case, the state directive, the employees are not eligible under the FFCRA for benefits. So I just want to make sure businesses know that, especially because we have new guidance from the governor on who is essential and who isn't. So beware of that. Some of the other guidance that's been given out is if anyone is taking paid sick leave or expanded family medical leave, they are going to have to be maintained on the health insurance plans. So just make sure that you're aware of that. The DOL has actually given us some additional guidance on other leave entitlements, and we talked about this in a prior webinar, but how does the FFCRA interact with your existing sick leave? They've given us some additional guidance on that, which I think is really important to pass along to all of you today, and that is that for the sick leave portion, when somebody is out on paid sick leave, the employer can agree to allow the employee to supplement the amount they're receiving for paid sick leave with existing paid leave. So for instance, if you recall, and you can see on this chart that is up on the screen, there's certain occasions where you're only going to receive 2/3 of your pay when you're out on sick leave. And those occasions relate to caring for an individual subject to quarantine, or the employee is experiencing any other substantially similar condition, which we really don't know what the definition of that is yet. We're hoping to get some clarity there. Or the employee is caring for the employee's child whose school or place of care is closed. So that's going to be a very common one. So if your employees are staying home to care for their children during this pandemic, they're only going to be eligible for 2/3 of their pay. So the DOL has provided guidance that says the employer can agree to offer to pay the remainder, the other 1/3 of their pay, through existing paid leave benefits under the employer's policy. That's going to be employer specific. If the employer agrees to it, they can. They're not mandated to do so. Similarly, if the employees exhaust pre-existing paid leave, just be aware of how this is going to work as far as the lengthy paid leave for the child care. So you're still going to have to offer that 2/3 pay for up to 10 weeks under the expanded FMLA. So just beware that you're going to be offering that 2/3 pay. Now, if you have some additional paid leave you would like to offer to make the employee whole, again, the DOL has said you can do that if you so choose, but it's employer-based. The employer has to agree to it. It's not forced on you.
And Jen, I had a quick question here. I wanted to jump in. So for businesses with fewer than 50 employees, I know we have some clients in that area. I know there was an exemption there before, but we didn't have much for guidelines on how to do that. Has that been updated as well?
It absolutely has, and just so everybody is aware, there have been regulations. They're not final regulations, but they're temporary regulations that have been issued. They were issued April 1st, And so we have had the opportunity to review them, and they did specify how small businesses are going to obtain an exemption. So I think this is really important for any employer who is under 50. An employer, whether they're a nonprofit or a for-profit, any small business that has fewer than 50 employees is going to be exempt from this law. And the way that they're going to claim the exemption, all you have to do as a small business owner is have an authorized officer of the business determine one of the following. Number one, that the paid sick leave or expanded family medical leave would result in the business expenses and financial obligations exceeding available business revenues and cause the small business to cease operating at a minimal capacity. So basically a real financial hardship. If you were to comply with the EPSLA and the EFMLEA, so those two provisions under the FFCRA, if you were forced to comply, it would cause a huge financial hardship. If the authorized officer of the business can determine that, then you are exempt. Number two, the absence of the employee or employees requesting paid sick leave or expanded family and medical leave would be a substantial risk to the financial health or operational capabilities of the small business because of their specialized skills, knowledge of the business, or responsibilities. So you're a very small business. If you had many people out, it would cause a financial hardship for your company because you're so small, everyone is basically an essential employee. The authorized officer can determine that, and you are then exempt. The third factor is there are not sufficient workers who are able, willing, and qualified, and who will be available at the time and place needed to perform labor and services provided by the employee or employees requesting paid sick leave. And these labor or services are needed for the small business to operate at a minimal capacity. So basically they're saying, look, there's no other workers out there, and you need the people that you have so you can exempt yourself. So again, provided one of those three conditions is met, all you have to do is have an authorized officer of the business make that determination, and you are then exempt. I want to be clear. No one has to submit anything to the government. This is going to be a self-certification by that authorized officer. Now, obviously, there should be some review and decision made as to which of the prongs is met and why, and you should be keeping paperwork as a company to make sure that if you're ever questioned, you can specify why you self-exempted, because you don't want to be called out on this and not have gone through the process of reviewing those three prongs and determining which one you meet, or if you meet more than one, and making sure that you put something in effect that says that you are exempt from this particular law, and here's why. So this is very important for all businesses under 50. It's going to be a self-exemption process. You are not going to have to submit anything to the government in order to self-exempt. There are companies that are under 50 that don't want to exempt themselves, and that's completely fine. If you are under 50 and you want to comply with the law, you can do so. Again, you'll be eligible for those tax credits, so it may be financially beneficial to you to do so. So you kind of have to weigh out whether you want to comply with this law or not if you're under 50 employees. So hopefully that helps answer that question, Jeff.
Yeah, and Jen, I'm obviously not an attorney, but those definitions seem pretty loose. So I feel like a lot of businesses in that under 50 category can make that case and get their exemption, assuming they've been affected somehow by this, which again, I think for businesses under 50, with some exceptions, most of them have been affected by this. So it seems like, again, doing your self-exception, as long as you have it documented well and you've gone through your test, that seems like something that's pretty straightforward to do, correct?
Yes, it is. I think the language is really broad, and it's going to allow, I think most people under 50 could make an argument that they are exempt. So I think most employers with under 50 employees are going to be able to make that argument if they want to. If they want to make themselves exempt, they'll likely be able to do so. The language is just so broad, they're going to be able to make the argument. Right, okay. And then so I know some clients, we've already started to get some leave requests. So can you just spend a couple minutes just reviewing again the documentation and everything that's
just the blocking and tackling mechanics around, employees requesting leave and the documents that are needed, both on the front end and the back end when they come back?
Absolutely, and we did get some guidance from the IRS about this too with regard to the tax credit, so I'll talk about that as well. So as far as what records need to be provided by the employee, basically, if you intend to take a tax credit for this leave, then you really need to make sure you're retaining appropriate documentation. And the IRS has said that you should be retaining that documentation for 4 years. So this is a requirement that's going to continue on, even though this law is only in effect, remember, until the end of 2020. So just beware that when an employee takes leave under the sick leave portion or the expanded FMLA portion, you need to get documentation from the employee. So what is documentation? What documentation do you need is a question that a lot of employers are asking right now. What can I ask for from my employees? And it's very tricky. So first of all, when you have these first few, if you're looking at the slide, the first one, employees subject to a federal, state, or local quarantine, that relates to isolation orders and self-quarantine orders that are in effect. Obviously, if Massachusetts issues a stay-home order, which they haven't yet done, the only thing that's issued in Massachusetts is a stay-home advisory. There is no government order yet to stay home or to shelter in place. If that occurs, then the employee may be eligible under that first prong, okay? And if that happens, what kind of documentation would you need in that case? Well, obviously, you're going to have documentation because you're going to be able to see that government order. And my suggestion to employers is you're not going to need documentation because it's going to be well publicized in the news as far as what the government's doing. But if it's a one-off situation, say it's an employee that is told they have to self-quarantine because they've come into contact with someone. So the employee was advised by a healthcare provider to self-quarantine. Let's go to that one. If that happens, you should ask for documentation from the employee, and they should provide documentation illustrating the need for leave. Hopefully, they can provide you with documentation from a healthcare provider that says that they've been advised to self-quarantine. What we're getting from the Department of Labor right now is ask for the documentation, but you need to maintain flexibility because some employees are not going to be able to get documentation, and you certainly don't want to bring somebody back to the workplace that's been told to self-quarantine. You can also, if somebody's not able to get it at the front end, you can always request it on the back end, and we'll talk about what documentation would be necessary in order for people to return to work as well. So employee is experiencing symptoms of COVID-19 and seeking medical diagnosis. Similar situation here. What documents should a company request? The employer should request documents illustrating the need for that leave, and they should specifically request anything from the healthcare provider that states they're going to be seeking testing or they've been tested. Now, again, given the current difficulty in obtaining testing or even medical care, some people, if they have mild symptoms, may be told just to shelter in place, self-quarantine for 14 days. Employers should not deny an employee the right to take leave simply because the employee cannot provide the supporting documentation. So obviously, as an initial step, employers should request the employee provide the information. And if the employee is unable to provide the documentation, again, what my recommendation is reserve the right to request documentation or require it as soon as the employee is able to provide it. So once they do go in and get tested, they can get a document at that time, or when they're returning to work, they can get the document at that time. Be flexible, but on the front end, always request the documentation because, again, remember, if you're trying to obtain that tax credit on the other end, you need good documentation in order to do so. Similarly, if your family member if you're caring for an individual subject to quarantine, like a family member, what documentation should the employer get in that circumstance? very similar. You should get something from a healthcare provider that says that you need leave because of the family member you need to care for that family member, or because you have to self-quarantine because you've been exposed because of the family member. So you should request that documentation. Again, be flexible. The last one is an employee caring for an employee's child whose school or place of care is unavailable due to COVID-19. We all know that schools are closed through May 4th. So, and we know that child care centers are closed through May 4th. So you don't need additional documentation because you have a government order in place that you're familiar with. All employers know that the governor has issued that order. So I would say that you don't have to request specific documentation because you have the documentation, which is that order. So those are the requirements that you should follow with regard to documentation on the front end. Request it, but be reasonable, be flexible, given that times are tough right now. People may not be able to get something from their physician or healthcare provider right away. Now, what documents do you need on the back end? Well, clearly we want to request something that shows that they are cleared to return to work in the event that they were subject to a self-quarantine, they were experiencing medical symptoms and seeking diagnosis, or somebody in their family was experiencing those medical symptoms or seeking a diagnosis, or their family member had COVID-19. So we want to get medical clearance that they've been cleared to return to work. And you can certainly do so, and you cannot return them to work until they provide that documentation. So make sure that all existing certifications for taking leave, you can request those certifications just like you can under the FMLA in any given situation when people are taking leave. You can request those certifications. So make sure that you continue to provide or continue to require those medical certifications from your employees during this time.
Okay. Excellent, Jen. So I know Jen and I, we have some scenarios that we're going to go through here. So I want to be respectful for everyone that does have to jump off right at 11:30. We did get some questions coming in, multiple questions coming in about a couple things around the PPP loans. So I think I'm going to take a couple minutes right now just to go through those questions. So Citron team, if you guys don't mind jumping in here, and they're really not for any particular person. I guess they are kind of, they're all around the forgiveness of the PPP loan. So there's three questions that have been coming in that have been asked multiple times, and I'll give you my understanding and then I'll let you guys jump in. But I know for the forgiveness, the question that's come in is, if you had laid people off and then you want to rehire people so that you meet that forgiveness, does it have to be the same employees that you laid off, or can you hire different employees? Maybe if you're switching from, if you're trying to bring in, I know we had a scenario the other day where they laid off people, but then they're hiring people from a technology standpoint to kind of build out their technology part. So my assumption there is that yes, that would count. And then two other questions around just the banks accepting loans. So are banks accepting loans right now? My understanding is yes and no. And then the mechanics where if the loan goes into a bank, do they underwrite it? Does the SBA come in and underwrite it? So I think first, Laura, that's probably a good question for you. So the same employees, or can it be new employees when you're doing that 8-week forgiveness period?
So our understanding from everything that we've seen so far is that it's just going to be comparing headcount. So, the headcount, and if you've brought employees back, meaning additional employees by June 30th, they would be included in the headcount for your numerator over the denominator. So I haven't seen anything yet to indicate that it needs to be specifically the employees that you previously employed being brought back. So
right, that's how.
Sorry.
Yeah, that's how I understood it as well.
There should be detailed guidance forthcoming on that, but as of right now, that's what we're thinking.
Okay. And yeah, Mark, this one's probably kind of goes along with what you're seeing from clients with the loans, but are banks accepting? Again, I've heard yes and no. Some people are waiting till today. Some people are waiting till next week. Some people have taken apps, but I'll let you answer there. And then just the mechanics. Do we know anything about the mechanics of when the loan gets to the bank, if they are accepting? Who's making that determination? Does the banker do it? Does it have to go to the SBA? Is it maybe both? Do we know the answer to that?
Yeah, so on the banking side, there's been a lot of, we're actually getting emails already this morning from some clients that their applications have been accepted, and I'm just speaking to the PPP loan. So yes, there are some banks that are already accepting applications. There are some banks that have already issued announcements that they can't get their portals ready till Monday. So they're not accepting applications today. They're going to be launching on Monday. But they are giving guidance in terms of the information to gather for your application so you're ready. And then there's some banks that are SBA approved lenders that have decided to back out of this. So ultimately the bank's going to be providing the funding, and that's why the PPP loan was created in the first place, was the banks are the conduit to get money into the hands of customers. So that's why the banks are going to be the ones sending the money out.
Right. And then the ones that aren't accepting, is it as simple? Is there a place they can go just to search for, SBA approved banks? Or what would be your advice if there's a small business and they're working with a bank that potentially is not, they don't want to participate in this program?
I mean, the quick answer is just to ask them, hey, do you recommend other banks that are issuing SBA loans? Right, they're in the business to do that, so they're going to know. But you can also, on the SBA website, they have the top 100 SBA bank lenders. So you can search there if you don't have a contact to go through, and they give you a list of 100 banks throughout the country.
Okay. All right. Yeah, those were the questions, that some of the common questions that have come in here. So, all right, great. Thank you very much for jumping on and answering those. Again, I wanted to make sure those got answered before 11:30. So we are going to go through. Jen and I have a bunch of case studies that we've kind of been working on, that we've seen in the marketplace. So again, with all this uncertainty going on now, and the governor extending everything through May, or through May 4th, we wanted to provide just some context around, if you're a business in one of these particular situations, here's some guidance, and here's some directions that you can go with your business, just to make sure that you're doing everything right. And, it might help you when it comes to making decisions with your employees. So the first one, again, a company, they're trying to decide whether or not to furlough employees in a full versus a partial furlough, so a reduction in wages or hours. So if they decide to make that furlough after April 1st, so like right now, if you were one of the companies that had said, you know what, I'm going to wait around until April 7th, see what happens, and then make a decision. So if you're one of those companies and now you have to furlough, Jen, would they still have to pay employees under the FFCRA?
So no, the Department of Labor has issued some guidance on that, and they've said if the employer closed after April 1st, anytime after April 1st, then employees are not going to be eligible for paid sick leave or expanded family medical leave. But obviously the employees may be eligible for unemployment insurance benefits. And again, this is true whether the employer closes because of lack of business or because of a government order. So it doesn't matter the reason for the closure, whether it's just economic conditions because of COVID-19 or whether it's because of that government order.
Okay. And then so this is the next one that's come up. So if you're in a business that's been deemed essential and you're open and operating, things are going on business as usual, and you have an employee over 60 years old and does not want to come in due to fear or anxiety for COVID-19, what are the resources for that employee specifically? And then what can the employer, kind of the can and can't do's for the employer?
That's a great question, and we've received that question several times. So basically the first thing I want to mention is the employee does not qualify for leave under the FFCRA. There's not going to be sick leave benefits for this particular employee because they don't meet one of the criteria. The second thing, though, is the employer should really engage in that interactive dialogue with the employee pursuant to the ADA and see if this is because of an underlying health condition or just anxiety. Because obviously anxiety isn't going to be that's just fear of this pandemic is not going to result in having to provide a reasonable accommodation. But if the employee does have underlying health conditions, then the employer likely will have to make a reasonable accommodation, which could include teleworking, modifications to the job description to provide for more social distancing, working outside if possible, a change in shift time to have less risk, taking unpaid leave or paid leave, depending on if you want as an employer to have them exhaust their paid leave. All of those things are options. So you would engage in that interactive dialogue if the employee has some sort of underlying health condition. If there's no impairment and no ability to telework, the next question is, can the employee file for unemployment if this is a situation? If the employee has this fear of coming to work. I do want to make mention that in the emergency some of the emergency regulations that have been set forth relative to unemployment and the expansion of unemployment under the CARES Act, there's been some guidance from the DUA in Massachusetts relative to this. And they have said that a self-imposed quarantine based on a reasonable fear of illness or exposure also qualifies the employee for unemployment. Now, we don't really know what a reasonable fear of illness or exposure means yet. We're hoping they can give us some more clarity on that because, in my opinion, everybody could come back and claim that they have a reasonable fear of exposure and a reasonable fear of illness, and then they could leave your work site and go on to unemployment, which could be a huge problem for essential businesses that need to continue to operate during this time period. So we're not really sure exactly what that means. I'm hoping we get some more guidance on what that means. I'm hoping it really is more limited to those that are at risk of exposure, but there are these FAQs on the DUA's website that state that if you are quarantined or you're self-quarantined due to a reasonable fear of exposure, you do not need to accept work until those conditions resolve, and you will be eligible for unemployment. So we're not quite sure what that means, but we have some real concerns there. Again, under these new regulations, it says work is not suitable if it endangers the health of the employee or others in the employee's household. So again, we don't know if people in supermarkets are going to say, well, my health is endangered because I'm coming into contact with a lot of people. And then they're not going to show up to work, and then they're going to try to claim unemployment. We have a real concern as employers counsel that could happen. So hopefully we'll get some more guidance on what this self-imposed quarantine based on reasonable fear of illness and exposure means.
Yeah, I had one the other day of someone who was very close to retirement in the transportation. They were truck drivers, and obviously they're essential and they're delivering supplies, et cetera. And they were close to retirement, so they wanted to get, their hours in from a pension standpoint. But, it's someone who was over the age of 60 years old and didn't want to put himself at risk. And they were having that exact conversation. So that's an interesting clarification if there's any guidance out on that, moving forward, because that seems like that could be a flood of people to the unemployment system.
Absolutely. And I do want to mention also with regard to unemployment that the CARES Act, as many of you know, specifically extends the number of weeks available for benefits to 39 weeks. And it also supplements the claimant's weekly benefit amount by $600, as many of you know. Well, we don't really know exactly what that means yet for Massachusetts, but if you have an employee that is getting the maximum benefit here in Massachusetts of $850, and then they're also getting that $600 on top of it, you're talking about the employee earning $75,000 on unemployment, potentially. So the DUA here has said they are not issuing any money to claimants under the CARES Act right now. They're not giving out that $600 until they get further guidance from the federal government as far as eligibility, exceptions, technical requirements, and the like. I think what they're very concerned about is somebody could potentially make more on unemployment based on this CARES Act $600 amount than they would working. And then what benefit to employers would there be for employees to return to work if they're making more on unemployment than they would make working for you? So I think that the DUA is saying, hey, we're not willing to pay this out until we have more clarification from the feds. And I think that's smart because, again, as employers counsel, we don't want to see employees incentivized to stay home. We want to see them incentivized to return to work. And typically unemployment, as many of you know, you never make what you make while you're working. There's a formula approach, and you make less than you would make if you were working. And so it incentivizes employees to come back to work. But if this is the case and they're getting this $600 on top of the maximum amount of $850, that could present a problem.
Right. And so I just want to be respectful of everyone's time here. We did tick just past 11:30. We have a couple of these scenarios that we'll probably stick around and just go through maybe one or two more. But for those who do have to jump right off at 11:30, thank you very much. We will send out this recording with some of the links that we spoke about. But we do have a couple more good scenarios that we are going to fly through. So for those who do have to jump off, thank you again. And for anyone that would like to stick around, we do have a couple more scenarios just to go through. We'll probably take maybe another 5 or 10 minutes to go through these. So thank you for everyone that can't stay on, and for everyone that can, we'll fly through a couple more of these scenarios. So Jen, this one here, again, a non-essential business working remotely, but now we're questioning the Sick Leave Act for someone who needs to self-quarantine due to pregnancy. So what are the options in this scenario?
So again, if somebody is being told to self-quarantine, but they're already working remotely, then you do not have to provide the paid sick leave because they're already working remotely and they're only being told to self-quarantine. Now, if they come down with the illness, clearly they're going to be eligible for the sick leave. So just be aware that if somebody's teleworking, you can not allow them to take that paid sick leave for quarantine purposes.
And then the intermittent leave, I know that was a question that had come up on one of our last webinars. But again, so bringing it up to the forefront with the FFCRA. So any remote work that receives a request from an employee to work 3 days per week, use 2 days under the sick leave. So do you have to allow the intermittent leave under the FFCRA?
So this has come up several times from our clients wanting to know, can my employee work Monday, Wednesday, Friday and take sick leave, or can they take the expanded FMLA Tuesday and Thursdays to care for their child? So the DOL has issued some great guidance on this, and they've basically said that you and your employer may agree that you can take paid sick leave intermittently while teleworking. So they've said yes, as long as you and your employer agree to that situation. They've also said you may take intermittent leave in any increment, provided that you and your employer agree. So for instance, you could take it in 90-minute increments. You could work from 1 to 2:30 and then take leave from 2:30 to 4 and then return to teleworking. Basically, the department has said they're encouraging employers and employees to collaborate to achieve flexibility and meet mutual needs, the needs of the business and the needs of the employee. And the department is saying they're supportive of those voluntary arrangements that combine telework and intermittent leave. Likewise, with regard to the expanded family medical leave, they've said that you can take that intermittently as well if the employer agrees to it. So can you take that expanded family medical leave? Yes, same thing as sick leave, but only with the employer's permission, again. So if you want to allow employees to work certain days of the week and care for their children on other days, or again, during the day, if you want to allow for a flexible work schedule, you can do that. But again, it has to be agreement of the parties. Now, you're not going to be able to take intermittent sick leave if you're taking it for sick purposes. For instance, if you're sick with the coronavirus, they're saying you can't take intermittent leave for that purpose. You'd have to take full days off, which makes complete sense. So there is some great guidance on the DOL's website about intermittent leave, but I just want everyone to know that you are encouraged as employers to allow employees to take intermittent leave on the sick side and on the expanded FMLA.
And Jen, I know a question came up last time about that as far as tracking goes. So I'm not sure, do we have any clarification on tracking that? Is it still done? I know the employer was required to do the tracking, but it was sort of left a little vague. Is there any continued or further guidance on on how that's supposed to be tracked, especially on the intermittent side. That can get administratively kind of be a heavy lift.
They actually have issued some guidance on that in the same FAQs that I mentioned, and basically they're talking about typically you would be required to keep hours and records, obviously under the FLSA, about what hours your employees work and when they work, and they're basically saying they're still requiring you to do so, but they're going to be a little bit more flexible given the situation and given the intermittent work that's going to be conducted. So just know you should be keeping records of what hours your employees are working, but they are going to be a little bit more flexible, and they're going to allow the employer and employee to come up with these very unique arrangements given the time.
Okay. All right. Thank you very much, Jen. So we have gone about 10 minutes over, so thank you for everyone who did hang around with us. As always, if you do have any of the chat questions, we'll try to do our best to get links or resources out along with the recording to make sure those questions get answered. Jen did share her COVID email last time we were on. Jen, do you want to share that email again, the COVID-19 email you have?
Yep, it's covid19@pfeifferpinkham.com.
Thank you. So if you do have, obviously the scenarios we tried to walk through can be a little more specific, but you have one very specific to your business. We'll do our best to get answers to you, whether it be through a CPA, whether it be through Jen. And obviously we're here to help. Rogers Gray as a company, again, we kind of say this as a broken record, but we are fighting the fight with you. So any questions that you have for us, anything that we can help with as far as aggregating information from your health insurance or trying to help with, any questions. If your payroll company is struggling with coming up with the data that you need, we'd be more than happy to try to help facilitate some of those conversations. But as always, thank you again for our webinar. Stay safe out there. And that's about it. Thank you very much, everyone.